Joining us now is Clockwise Capital partner and portfolio manager, James Cakmak. James, good to see you again. I notice that in your terrific three, we got to come up with a new name, of course, Super Six, terrific three, whatever it is. Apple was not on the list.
Yeah, essentially the way we think about the names that we want to lean into and truly overweight is based on how predictable is the revenue picture and the earnings outlook. And on top of that, how much optionality is priced in or not priced into these stocks. And we think among the seven, only Amazon, Meta, and Microsoft had that predictability as well as optionality. And the other ones, we have question marks on, like as Steve was reporting, what happens with Apple shipments, iPhone shipments this year, Tesla kind of throwing their hands up in the air on unit sales for the year. So there's more questions than answers on the four. So we're leaning into those three.
Yeah, and you heard Steve talking about Apple, and I'm not picking on him again. Everyone loves their iPhone. What I'm saying is that it feels like Apple is a phone company. They've got augmented reality. It's going to be cool, but that's got to be a niche product. Of course, the MacBook, they're great, but you buy one, it lasts hopefully 5 to 7 years. And the iCloud services business. In your view, what is the proper way to value Apple? Just pure phone sales?
I mean, we do look at it on some of the parts basis, but ultimately I think that investors will just predominantly value this on a PE basis. The sum of the parts doesn't always add up to how investors analyze and value these companies. So on an earnings basis, we think around 30 times is the right number. I think the real question is what happens to revenue. Now, we do think that MacBook sales will accelerate this quarter and potentially come in ahead of expectations. I think the big question mark is on the iPhone, whereas we already know that services is going to be up double digits. So I think as long as iPhone does well, I think it'll continue to grind higher. But it's not one that we're going to make a top weight in the portfolio.
Very confused by Meta, the former Facebook, because it got destroyed 2 years ago, year and a half ago. The stock tanked. It has now made up all of what it lost and more. How can a company like that, has products, Facebook, Instagram, WhatsApp, they've been around forever, fall that much and then recover that much? What happened?
Well, it was really just Apple changing its privacy standards.
That was it. That was it. That little button we get when we log on to a new app, it says ask app not to track. That was it?
Essentially, yeah. But it was on by default for Apple services. But you had to toggle it on by manually for non-Apple services. So what's interesting about it is, yes, that was a really tough year for Meta, but they actually came out of that stronger and more defensible. And the changes that they made and the improvements that they made on the targeting side actually made their products stronger and ultimately yielding higher ROI conversions for advertisers. So we think Meta's in great shape. I think the big question mark we have now, it is a top weight also, but the question mark we have is, is the religion on the expense side sustainable or not? Obviously, we're going to get color on that tonight, but that may change the calculus. If it's sustainable, we think that at 25 times earnings, with $20 in earnings forecasted, this could be a $500 stock.